Hey everyone, so my name is Zach Vines, and what we're going to look at today is just an overview on how you work with T accounts in your accounting classes. So T accounts may seem like kind of a new concept that you have to work around and learn, but really at this point you've probably been familiarized with journal entries, where we simply debit one item and credit another item, or increase the balance in a certain account, decrease the balance in a certain account. There's a whole accounting equation that kind of details which accounts are increased and decreased based on debits and credits, and that overall format should be fairly familiar to you. If not, we have an entire playlist on the channel, just an accounting playlist that goes through various items like that. We have the accounting equation explained, a debit and credit tutorial that gives you a few examples on how you debit and credit certain items. So I suggest you familiarize yourself with that before you get into the T accounts if you're not too comfortable with what I just said. But really the idea of a T account is that it's just a way for us to keep our accounts organized. So it's organized in such a way where we have an account name where we have debits on the left and credits on the right. You can see it's called a T account because it makes a little T like that. So it's just account name on the top, debits on left, credits on right. So it starts off by giving you your beginning balances, assuming that you did have one, assuming it was a permanent account that rolls over year to year and not a temporary account like something we close out like revenues and expenses and things like that. It starts with the beginning balances, shows you all your changes in your balances that will result in your ending balance. And so what that's going to do is help funnel directly into your trial balance, which we also have another video detailing the flow of the financial statements, kind of why we have to do it in the order we do it. So really we start by journalizing our transactions, posting them to our T accounts, and then that's going to funnel into the trial balance. And when you have your trial balance, you want to make sure that the ending balances you have from all of your T accounts, all of the debits are going to equal all of the credits. And so just as an example of a couple of T accounts you may have, for the cash section right here, you might begin with a certain amount in cash. Hopefully you do, unless perhaps it's your first year of business, but rolling over year to year, hopefully you have some cash in your beginning balance. And so you can see I have it on the debit side because cash is an asset and thus naturally holds a debit balance. So if I have $100 cash in my account for this business, then I'm going to have a debit balance to begin with. And then these little circles right here, those just tie to the transaction numbers at play. So you'll see in a moment we're going to get to a comprehensive example where we have multiple different transactions, and really us labeling 1, 2, 3 are just our ways of being able to identify, okay, which transaction, like which problem in these series of problems did I write that down because of. And so apparently we added 50 to our cash right here because of transaction 1. We took away 30 cash right here because of transaction 2, because we credited it. Credit decreases your cash balance. We added 10 right here, and all of that's going to funnel through into an ending balance. So 100 plus 50 minus 30 plus 10 should equal 130. And just for another example, you can see this notes payable section right here. Because it's a liability, we have a beginning balance that's going to be on the credit side. So we begin with a total balance of 500 in our notes payable. Then we take away 50 because debiting decreases the liability. We add 200, and that leaves us with an ending balance of 650. Had to change the number there for just a moment. So that should give you a good overview on how the T accounts are organized. So let's go through one comprehensive example where we can show the various debits and credits and how they funnel through into those T accounts, and do that right now. Okay, so you can see that here we have a pretty comprehensive example with several different transactions, and even before we actually get to the answers, you're going to see there's a few T accounts involved right here. Let's just take it step by step and talk about everything we just did in practice. So we start the year off with $2,000 in cash, $2,300 in our wages payable, and $300 in our accounts receivable. So already you can see that our accounting equation is balanced out because we have 2,000 assets in cash, and then 300 in assets with the accounts receivable. So 2,300 on the left side of the equation, and then the 2,300 wages payable is a liability. That's what's on the right side. So 2,300 equals 2,300. So we should be good to go as far as that's concerned. This is a pretty simple, basic example. Obviously, as a company, we'd have far more assets, liabilities, and equity apart from just that information. But just to start off with, that's what we're rolling with for the time being. And so for the first transaction, it says we recognize the obligation to pay employees $1,200 in the future. So before we even get to that particular transaction, just understand that we're going to journalize all of these transactions first, just debit and credit them like you're probably used to doing up to this point, and then we take those and translate them into the T accounts. So I suppose you could jump straight into the T accounts once kind of the concept behind them is very well understood because they're basically just journal entries summarized by account in these neat little formats. And so you could jump straight to that, but just kind of from a beginner's point of view, I would start off by journalizing them as such. So to start off with, recognizing the obligation to pay employees $1,200 in the future means that we haven't paid them yet. So we need to recognize that we need to pay them in the future, thus create a payable or a liability. And we need to go ahead and recognize the associated expense with that is just the case that we're going to square away the cash later. So, these concepts I'm going to kind of breeze through. We do have plenty of other videos on the channel in that playlist, like with accrual accounting explained, deferrals explained, and everything like that. But this is more so focusing on the format of the T accounts as opposed to how you do exactly every single debit and credit. So we're just going to breeze through that. So debit wage expense, credit wage payable, $1,200 each. We're good to go. Number two, we sold $800 of goods on account. Well, if I sold them on account, I didn't get cash for it. I'm going to create a receivable for it and get the cash for it later. So I'm going to increase the balance in an accounts receivable or debit it by $800 and go ahead and recognize the sales revenue because I have actually provided that, or not provided a service, but I have sold that product. I've given that product to the customer. Thus, I've performed my obligation. Thus, I get to recognize the revenue on the front end, just square away the cash later through the receivable. So we have 800 and 800 debit AR, credit sales revenue. For the third one, we collected $400 from our receivables. So basically, it might not be from this exact sale that we did, but we have some amount in our receivables, and we have now collected some of the cash from it, in this case, $400. So you're going to increase your cash account, debit it by $400, and decrease your accounts receivable account by $400 as well. And then finally, when we pay off $1,400 for wages, that's likely referring to the fact that we tend to create payables for our wages expenses. Anytime we're going to pay someone their salary or whatever their wages are, we're probably going to create a payable on the front end and then pay it off in cash on the tail end. Here we're paying that off in cash on the tail end. And so we're going to decrease the balance in our wages payable by debiting it, and credit decrease the balance in our cash accounts by $1,400, both by $1,400. So finally, to get to the T accounts right here, you can see that, let's just start with the cash account at first. So we had 2,000 as of the beginning of the year. We start the year with 2,000 cash, so I have a debit balance of 2,000 because assets naturally hold a debit balance of 2,000. And you can see for 1 and 2, nothing impacted my cash account, so I'm not going to have anything dealing with 1 or 2, this is just 3 and 4 for my cash account. But once I get to 3, you can see that I debited cash by $400. So just go to the debit side, put down $400, and label it from number 3, and that's all you do. And then with number 4, we decreased our cash account, we credited it by $1,400. So I just label it transaction 4, and I put $1,400 right there. And then I go, okay, well if I started with 2,000, I added $2,400, I took away $1,400, that leaves me with an ending balance of 1,000 right there. And so you pretty much do the exact same thing for every single one of these accounts. So we'll kind of breeze through them. Wages payable, we began with $2,300 in our wages payable, so I put that on the credit side because it's a liability. And then you can see from number 1, I credited wages payable, so just put it on the credit side and label the transaction that it came from. And then we don't have anything dealing with wages payable until number 4, so I label number 4 and I debited wages payable by $1,400. And so when you funnel all that, 23 plus 12 minus 14 leaves you with 21. For the accounts receivable right here, we began with 300, and you can see numbers 2 and 3 debited and credited the accounts receivable account accordingly, and you funnel all that into a final number right there. The only real point I want to make about these two accounts right here is to note that there was no beginning balance in these accounts because expenses and revenues are known as temporary accounts, where at fiscal year end, instead of us deciding, okay, we're just going to keep rolling over our revenues and expenses into the previous year, really those are intended for us to net them into a net income. Hopefully it's an income, could be a net loss. And then that is then funneled into retained earnings and thus stockholders' equity. And so these don't roll over year to year, so we actually don't have a beginning balance. So you can just see that I recognize my wage expense from number 1, and that is my total wage expense right there because there's no beginning balance to kind of add or subtract from. Same deal with the sales revenue. It's just 800 right off the bat, so I put down 800 right there, and so that's how you fill out your T accounts. So I hope this gives you a pretty good overview on the format of it. It's pretty simple. You just have the account title on the top. It makes a little T as such. Then start off with your beginning debit or credit balance. journalize all your transactions so you can just neatly apply them to all of these T accounts, come up with your ending balances, and that then funnels into your trial balance, where hopefully all of these ending balances we have, the debits will match the credits, meaning that everything we journalized was correct. So thank you so much for watching, and I hope that helped.